This is Mike Gallagher from IDEAglobal. We want to look through some of the key themes for 2014 and some of the key views that IDEAglobal has. I want to start the presentation today, and we've got quite a bit of a slide deck here to run through, by first of all looking at probably the most important issue for next year in the shape of the Federal Reserve. But it's not just the Federal Reserve that's important. I think it's also worth paying heedance to what's happening with both the Bank of Japan and then also crucially the ECB. This first chart here shows the secular increase in the central bank balance sheet, which has been so crucial to reflating global assets since 2008. This has not just been a function of the Fed, but also has seen the ECB being a key contributor, and latterly, the Bank of Japan. IDEAglobal, like very much most of the market, feels that the Fed are likely to taper by about 10 billion at the 7 FOMC meetings in 2014. Meanwhile, we see the Bank of Japan increasing its purchases by 20%, most probably at the April meeting, given the approach of the sales tax. Combined, the Fed and BOJ balance sheet should increase by around 22% by the end of 2014 compared to November 2013 levels. The crucial part has actually been the ECB. Since the OMT announcement, the ECB's balance sheet has actually shrunk by 19%. And if we go back to the first graph, this has largely offset the increase seen in both the Fed and the Bank of Japan balance sheet, so that the total G3 balance sheet is now very similar to the levels that existed in late 2011. We are likely to see the ECB turning around and actually continue process where we see an increase in the balance sheet in 2014 rather than shrinkage. The combination of weak credit growth, low liquidity amongst the money market participants, and the need to avoid a funding cliff at the end of 2014 is likely to see a succession of LTROs from the ECB. In the spring, this is likely to be a 12-month LTRO to fine-tune liquidity, but then a more macro-driven and real sector-focused LTRO is likely to arrive in the autumn. Net-net, we see the G3 central bank balance sheet expanding around 15% in 2014, which is actually larger than the central bank balance sheet expansion for the G3 in 2013. The market has so far taken Fed tapering in its stride. There's quite a lot of focus that if you forecast a step down in the Fed purchase rates through the course of 2014, that you could easily end up with a Fed balance sheet of around $4.5 trillion. And given the close relationship with the S&P 500, this is the market thinking about a sort of a 2000 level on the S&P 500 towards the end of 2014. The crucial issue in terms of Fed tapering is likely to be the expectations of Fed tightening. Tapering in itself will tend to sap the market a little bit, but progressively as we go through 2014, the crucial issue is where the market expects the first date of tightening. At the moment, the FOMC and the market expect that to occur in 2015, so there is a gap between tapering and tightening, but it's not too long. We feel that as time progresses, a Yellen-driven Fed could delay this tightening timetable, both given the lagged disinflation from the great financial crisis and the spare capacity that exists in the economy. The Fed also need to clarify the timetable in terms of future asset sales, which is something that they haven't really updated since 2011. Overall, we're really looking at the 2-year area of the curve. This is going to be critical. If we see a sharp rise, then the market will start to really sort of fear tightening, and that can ripple through global markets and produce risk-off phase. If the Fed can control the 2-year, however, then we might be able to see an uneasy rally in equities extending and riskier markets. But for us, really, the clearest winner either way is likely to be the dollar. We see a dollar re-rating coming progressively, either as the market draws a distinction between tapering and tightening, or alternatively becomes a little bit more concerned about eventual tightening. The best way to play that is versus the yen and commodity currencies. Just one long-term word, the Fed do need to be very careful in terms of interest rate expectations. They recognize this. Yellen has talked about the lower for longer phase, but the lower for longer, and even in the Yellen view of the world, does eventually mean an overshoot in terms of the Fed funds rate. So instead of, say, moving from current Fed funds rate levels to a long-term 3.5% equilibrium level, it may entail an overshoot. The Fed need to be very careful in managing those expectations, and consequently we see the Fed and all issues surrounding the Fed being the dominant issue for global markets in 2014. The second major issue is how China manages to sustain growth while undertaking reform and cleaning up the financial system. It's a difficult balancing act, but Chinese policymakers have sufficient number of fine-tuning tools in terms of macroeconomic policy that IDEAglobal sees a model-through scenario for China in 2014. At times, the market will become fearful about a shakeout in the financial system, just as we saw in June of 2013, but this is unlikely to produce a major crisis in the Chinese markets or Asian markets. Instead, we see it as part of an ongoing process that the Chinese authorities are likely to manage. So in terms of the foreign exchange market, the story is very much the Fed tapering and then eventual tightening expectations generally lifting the dollar. We think the best way to play this in the first half of the year is on dollar yen to 110, and then against the commodity currencies. We particularly feel that the Canadian dollar can catch up with the movements that we've seen in the second half of last year in the Aussie and the Kiwi, but generally commodity currencies are expected to be weak. Star performer, well, that could well be sterling. We think that the market will be concerned about rate hikes arriving before the Fed, and that can produce a re-rating of euro sterling towards 79. Just looking at dollar yen in a little bit more detail, one of the things that has been very evident is the close relationship between central bank balance sheets and equity markets. People are very familiar of the graph that we showed before in terms of the S&P 500 and the Fed balance sheet. Here we've got a graph showing the Nikkei 225 and the BOJ balance sheet, which could ultimately, if the relationship holds, point to close to 20,000 on the Nikkei. One interesting relationship, however, is the Bank of Japan Fed balance sheet relative and dollar yen. This has been reasonable over the last 5 years, although dollar yen has run ahead of the actual movements that we've seen in the relative Bank of Japan to Fed balance sheets. The red line here is ahead of what's actually been happening. But the prospect of the Fed slowing down and the Bank of Japan accelerating its easing process is consistent with at least a 110 dollar yen, and we'd expect that to be the long-term structural view. The one thing to watch out for in terms of the yen and Japanese assets is inflation expectations. So far, the Bank of Japan has been successful in helping to maneuver up CPI inflation. But the real test is when it brings wage inflation and inflation expectations higher. After some initial euphoria in the early part of 2013, we've actually seen inflation expectations, as represented by the 5-year here, become pretty stable, pretty static. The Bank of Japan needs to produce a further pickup in inflation expectations to be truly successful. Part of that will come in terms of the easing that they do in April, but the market could, at some stage in 2014, question whether Abenomics is being successful and whether the Bank of Japan's strategy is right. Just coming back to the Canadian dollar, we have sort of highlighted here in the charts that we've got a very similar pattern actually to what happened with dollar yen in 2012. And we think that we're very close to a breakout phase on the Canadian dollar that will take us initially to 109, then 111. But the upside is very significant, and we could ultimately look for a move up towards 120. Turning to Europe, there's been a trend in global markets to look at the relative value of US equities, which are deemed on most models to be overvalued relative to, for example, cyclical PE measures, while a lot of the European equity markets are actually undervalued on these kind of longer term CAPE measures, the cyclically adjusted PE ratios. There is sort of scope for a bit of a further re-rating in the early months of 2014. If we look at the event risks that exist, there's very little on the calendar apart from the European elections in May, and they may not prove to be of long-lasting impact on European asset prices. They will certainly see a protest in terms of a number of countries against the whole euro order, but that's likely to be seen by markets as a protest vote and not necessarily as prompting sort of a sea change in attitudes. This also to a degree applies in terms of people looking to pick up European assets to the distressed markets. Ireland, Italy, Spain, and Portugal are shown here in the graph in terms of the performance from the beginning of 2007 through to 2013. And there is still some further sort of recovery prospects. The European picture is also likely to be helped net-net by the ECB asset quality review and EBA stress tests, which are due to be published in October 2014. The central expectation is that the increased capital that will be required will be somewhere in the region of 20 to 50 billion, which is very manageable for the size of a banking system such as Europe. The euro is also supported in the short term by the large current account position. So we wouldn't really be sort of too aggressive in terms of euro dollar in the early part of 2014. Indeed, if you want to sort of play something, euro Swiss looks as though it's about time that we see an adjustment there. The Swiss franc generally is the last of the great safe havens not to have adjusted. We saw treasuries, gold, and the yen all selling off in 2013 as the risk appetite increased globally. We feel that this will be the case for the Swiss franc generally in 2014, and we like short Swiss franc not only against the dollar, but we can see scope for a move to 126 on euro Swiss. Nevertheless, as time goes on and as the ECB undertakes easing while the Fed are tapering, we think that this can turn around euro-dollar. And also it's worth pointing out that in the second half of the year, some of the long-term structural issues are likely to come back into focus. This graph here represents the overhang of credit that we have in the advanced economies, which is predominantly the Eurozone. which hasn't really sort of adjusted as of yet, and we've still got many years of deleveraging ahead of us. Turning to the emerging market space, the performance of currencies since the Fed have tapered has been characteristic of 2013. Four of the vulnerable five, in terms of Turkey, Brazil, Indonesia, and South Africa, have all seen clear weakening of their currencies versus the dollar, as people are concerned that the combination of adverse current account positions, an election in all five countries, are likely to produce a difficult investment horizon in 2014, which will sap currency flows and will mean the need for currency weakness. Nevertheless, they're not necessarily all the same. There is a situation in terms of Brazil that if you look at the current account position, but you add in net FDI, that the direct investment flows pretty much produce a bit of a balance for Brazil. And as we go on through 2014, we could see a little bit of a distinction drawn amongst the vulnerable five. Turning to currency-specific forecasts, we think that the yuan is likely to remain strong through the course of the first half of 2014, before the strong dollar has a bit of an impact. That the Brazilian real stabilizes and holds its own, and that the Russian ruble is very much something that can hold its own against a strong dollar, while we expect the underlying poor current account position in India to produce further weakness. This is Mike Gallagher from IDEAglobal.